Hello, everyone. We're going to start talking about some individual stocks today. So before we get into one of the first individual companies, we're going to talk about the valuation of stocks. So to value a company, a stock current price reflects all available knowledge and prices and future prospects. The price is a function of future earnings and cash flow coupled with current income, dividends, and a multiple being paid on those earnings, which is a valuation. Fundamentals change over time. Most stock movements in the short term, that could be daily, weekly, monthly, yearly, they reflect a change in the multiple. And that's based on sentiment, positioning, events, news, and other things that affect people's perception of that particular company. Valuation in the long run, 5 to 10 years, is the biggest driver of excess return, along with those fundamentals. So the first company we're going to talk about is Newmont Mining. They're the largest gold mining company in the world by market cap. The biggest drivers of revenue for Newmont are the price of gold and production. The biggest drivers of cost are finding new reserves, so the cost to find the new gold mines, and diesel prices, which is the variable cost of powering your machine so that you can go dig up the gold. So commodity prices are very cyclical, and commodity company valuations reflect this. So it's one of the things that's pretty interesting. So with mining companies or companies that use commodities as their business, commodity prices are very volatile and they move up and down and they're very cyclical. And that's mainly a function of supply and demand. When prices go higher, a lot of companies that are in commodities will start to invest all their excess money to find new reserves and create new production. That drives supply higher. As supply goes up and demand and prices drop, that causes prices to drop, and then they pull back on finding those new reserves, and that causes the up and down cyclicality of commodity companies. And valuations reflect this, so they tend to be lower than some of the other companies that have stable earnings. And the underlying commodity prices, they are the biggest driver of sentiment and money flows. So when commodity prices are going up, people flood into the commodity producers. When they come out, they flow out of the commodity producers. So let's take a quick look at Newmont financials. So you can see here, this is 21, 22. This is, last 12 months, but basically 23. So we'll leave this one out. 24. So these are estimates going forward, 24, 25, 2026. So you can see revenue is relatively stable the last couple of years, a little bit of a drop this year. It's expected because gold prices are down a little bit. And then you can see a bump up in price or in revenues into 2024. We'll talk about that in a minute. The biggest reason why you're seeing this jump in 2024 is Newmont actually made an acquisition of Newcrest Mining, and that's expected to close at the end of 2023. So that will be a boost to their revenue. I'm not going to go through the different profit margins, but you can see EPS here on the bottom. So it's dropping. It's actually expecting, this year to kind of be the low, or the last 12 months to kind of be the low, and then earnings are expected to jump up thereafter. More importantly, what I'd like to point out is at the bottom here, which is free cash flow. Again, basically slight drop this year, but a bottoming this year in the cycle, and then it's expected to increase much more significantly cash flow than earnings per share. That's important for a couple of different reasons. The more cash, the more availability to either buy back shares, increase dividends, etc. But just from a financial perspective, the low, and it's not bad, this is not a bad thing, but the low of the cycle is expected to be this year for Newmont. Next, I talked about that acquisition. So the forward estimates, if we go back real quick, forward estimates for 2024, so 11 billion to 13 billion, reflect mainly the acquisition of Newcrest Mining. So they actually do about $4.8 billion in revenue. The difference here, again, you're talking about $1.5 billion increase in revenue next year. So actually, there's a pretty big drop in gold prices expected, or at least built into these estimates for next year, and actually no change if you just look at a revenue perspective, slightly higher and then slightly lower. Basically, not much of a change in the price of gold going forward. Those are the expectations that are currently built into Newmont. So, and actually, before I go, so here's the acquisition of Newcrest Mining that's expected to close at the end of this year. Some other things that you might want to see here are the stock buybacks. So they do buy back shares when they are undervalued, and they've used that excess cash. So go back to free cash flow. They use that to buy back shares, which should help boost the share price. So that's a good thing just from a management perspective that we've seen in the past. So now we're going to talk about gold prices, because that is a big driver for a commodity firm. We're going to take a look at the 1970s, because that is the best comparison we can have right now to the current economic backdrop, because we have an economy that has built-in inflation, is not doing terrible, but you kind of have this, it's a stagnant economy. It's not doing great, it's not doing bad, but you have inflation, so things feel a lot worse than maybe they are right now. In fact, in the 1970s, we had a few recessions, and one of the things that did best was stock prices didn't do very well in the 70s. Bond prices didn't do very well over the 70s, but gold actually was the best performing asset. And why do I want to point this out? Because even though it was the best performing asset over the course of that decade, you can see that there is, it's very cyclical, just like the commodity producers. So you can see in the early 70s, gold went up about 400%. Then over the course of the next several years, it actually dropped 41% before it bottomed. And then over the next several years, it spiked up another 570%. Now, what do I want to show you, because this is going to be important moving forward, is these spikes happen very, very quickly. And then the downward move is drawn out and takes time. You start to recover that upside, and then look what happens once you break above the previous high. So here's the previous high, several years where you drop slowly, you came up slowly, you get to this level, you break out, you retest, and then it goes parabolic to the upside. Very, very common in commodity prices. And it's important because this is setting up very similarly to where we are now. We're right around this level, if you compare from the 1970s to today. So we're talking about Newmont and the price moves that it has. Miners are more volatile than the commodity. Makes sense, because it's not just supply and demand. You have a company that has to function, and you have risks inherent in producing the gold. You have risks inherent in selling the gold. And so they tend to have larger swings than the commodity. Interestingly, you have, similar to what I showed from the gold price in the 1970s, you have this long drawn out sell-off, and then a very, very quick spike in price. This is 171% in about 5 or 6 months. Now you have this long drawn out, you're talking about 3 years, almost 4 years of consolidation, where it's long and drawn out. And again, not steep drop, but we've had no new highs for 4 years. And then a quick spike in a matter of 5 months of 119%. Sideways move, drawn out, 64% in 3 months. You have an initial shock drop, and now we're in this long drawn out process that's taken a couple of years to play out. And that's the nature of a commodity operator and a commodity business, is you get this frustration where you get these long drawn out downsides, and then you get these quick spikes in price. And so it's something that, even though gold prices, which we're going to talk about next, even though gold prices are only 9% off their recent highs, you've got a stock in Newmont that is well below 50% of where it was just in early 2022. So gold prices, and this is where it's going to get important, the all-time record high was back in 2011. And you can see here, and this is, you can see here, this is 2011. Those were the all-time highs. Long drawn out drop, very similar to what we saw in the price. Spike higher, sideways move, a spike higher. We're in the sideways move again right now, only 9% off its highs. Sentiment and positioning is one of the most extremely negative that we've ever seen. Now we go back to what drivers are in price. Sentiment and positioning are two short-term drivers. Why is this important? Because as you sit near all-time highs, if this price were to recover and break to new all-time highs and people are positioned negatively and their sentiment is negative, then they're going to be forced to chase. When they're forced to chase, that provides more buying power, and that's what causes spikes like this that you see, spikes like this that you see in commodity prices. And that's why it's important to in the case of Newmont Mining, you have to look at the commodity as well as the underlying fundamentals of the company. Now, this is what's interesting to me is gold versus gold miners. Typically, they move very, very similar. So going back to 2011, the white line is gold, gold miners versus the price of gold. So when it's moving down, that means gold miners are underperforming gold. When it's moving up, gold miners are outperforming gold. And they should move very, very similar. The blue line is the price of gold. As you can see, from 2011 to 2015, it's almost identical. 2016, 17, 18, 19, basically till this point in time, almost identical in the move. And now you have this huge break. Let's call these the alligator jaws, basically from mid 2020 until today. Gold miners are significantly underperforming relative to where the price of gold is. So you can see price of gold is right near all-time highs, and gold miners relative to gold is sitting near, not quite near the lows of 2015, 16, but similar to what we saw in the spike drop in March of 2020, similar to what we saw in this drop in 2022. It's sitting near the lows. So there's a lot to catch up on. Should we get that breakout in gold, gold miners have a lot of catching up to do. So where does that put us on where the price of Newmont can go? So in our view, there's meaningful upside and revision to earnings. So, and cash flow, given the potential for gold prices to stay elevated. That doesn't even mean that gold prices have to break out to record highs. There's meaningful revisions even if gold prices stay where they are. If you remember, they're buying Newcrest. They have almost $5 billion worth of revenue, and you're only expecting $1.5 billion worth of revenue increase in Newmont next year. That means there's a significant, you're talking about $3.5 million worth of decrease, $1 billion based on the decrease in gold. So gold prices staying elevated can, even without going to new highs, just staying where they are, means you can have a meaningful upside revision fundamentally to earnings and cash flow. Additionally, there will be approximately a 35% increase in production just from the purchase of Newcrest. The current dividend is a little more than 4%. So yes, it's a commodity producer. They don't keep their dividend exactly where it is, and it will move from time to time. However, current at 4%, even if gold prices stay equal, you could see an increase to that dividend with excess cash. If gold prices break higher, that dividend will get increased. It will absolutely get increased because when prices go up, Newmont in the past has increased dividends rather quick. And where does that leave us? In a stable gold environment, we value shares around $55 to $60, which is about 44% higher than the current price. That doesn't even include the 4% dividend you get. At record gold, assuming we would break that all-time high, at record gold, we value shares near $80. It's about 110% higher than now. So as you go through, even though the price of Newmont has stagnated and dropped, in our view, it's significantly undervalued. And as we've seen in the past, those moves higher happen in a very, very short period of time. So we could see when it goes, Newmont is going to move very, very quickly to that 55, 60, or even $80 in several months. I'm talking 3, 6, maybe 9 months. And that would probably be an opportunity to take our profits in Newmont. But until then, we think it currently provides excellent value and a good opportunity for growth, not only in income, but also in share price.